I'm wondering what you make of what Einhorn said about the industry itself being dead.
Like Mark Twain said, reports of our death is wildly exaggerated. I'm reminded of the Business Week cover in 1979 reporting on the death of equities, which managed to almost perfectly pick the absolute bottom in equities, and we had the best 20-year run in equities ever following. It is a very positive sign that people are being so negative on the sector, clearly out of favor. There is no denying the last 15 years, with the exception of last year, and I'll come back to that in a second, there was 15 years of headwinds for value. Why? Because interest rates declined for 15 years. And value stocks earn their money in the near term. And so we don't get helped as much by a drop in interest rates as companies whose earnings are 30 years into the future, who get helped a lot by a drop in interest rates. So that is not going to continue forever. It already stopped last year, and value stocks beat growth stocks by more than 16%. Russell does a much better job of differentiating between value and growth than S&P does, and the Russell Value Index beat the growth index by over 16% last year. So we are, reports of our death are exaggerated.
Eric, I mean, Charlie makes a good point. Fed-induced, right? You got all the money pouring into the system. Of course growth is going to outperform value. You don't need to be a rocket scientist to figure that out. So why in the world would it continue to outperform value at a time where the Fed is taking that money out?
Well, Scott, I think that interest rates get overplayed as sort of this reason why value underperformed or why growth overperformed. Obviously, it's been a big headwind for growth in the last year, but growth stocks did just fine in the late 90s, in the middle of the dot-com bubble when interest rates were much higher. I think the reason why growth stocks in general, and I agree with Bob that the definitions are important here because things get murky. But I think the reason why people are attracted in general to growth stocks is because, surprise, surprise, they grow more. Their growth rates are higher than value stocks. And I think eventually that's the siren song that calls investors back to these kinds of names because they get attracted by these high growth rates. And I think that is going to happen again. Growth obviously has had a bad 2 years, not just 1 year, bad 2 years. But people are always going to want to come back to the specific names that they think have the best chance of growing over the next little while.
Which is why, Charlie, some suggest that, this couple steps forward that value has taken for the first time, and as you mentioned, a number of years, is going to be short-lived. That Eric's right. When the environment is right, it's going to go right back to growth.
But this is not 2 steps forward in an otherwise backward-moving story for the 100 years. At the University of Chicago and the Center for Research and Security Price has been calculating value versus growth since 1926. And value beat growth for every 10-year period, every single one, until we got to 2005. The value effect has dominated growth for a long period of time. Why? It's because of what was just said. People want to own growth. Popularity bids up the price and brings down the returns. He's absolutely right that more people want to own growth than something growing at 4 or 5%. That's why they overpay for growth stocks and why we can pick up better returns.
And maybe, Eric, Charlie's right in that in this new environment that we are in, people are going to be more selective. Stocks with lower valuations, as Einhorn points out, the ones that are being ignored are going to be the ones that are more popular, the ones that are returning more cash to shareholders. The landscape's changed, and so too is this conversation.
Well, I think it's you're making the case, Scott, for active managers. Because passive indexes have hurt active growth managers just as much as they've hurt active value managers, which David was talking about today. I think it gets down to, which names are you going to invest in? Right now, I could pay 44x forward PE for GE, as Jim Chanos has pointed out on your show, or 40x forward PE for Clorox, and something like mid-teens for Google and Meta. So what's the best stock? I mean, you got to do your homework. I think there are some profitless tech companies that always seem to get a bad rap by a lot of folks these days. That if you look 1 year out, 2 years out, are going to have stellar returns. They are just being left for dead at the moment. So the point I'm making is you really have to do your homework and put your bets on very specific names, which is kind of what David talked about today. I mean, his names I thought were fantastic names, like with very low. These were not GE, type forward multiple names that he was talking about on your show earlier today.
I love the way you put that. Profitless tech getting a bad rap. Okay, that's a new one. Charlie, I give you the last question. Marko Kolanovic, JP Morgan, puts forth something that it's in the wheelhouse of this conversation. I want your opinion of it. Value versus growth run has stalled. The next trade is likely to be outright underweight value. You want to take that on?
Yeah, I don't think that's right. I think the value right now is overweight cyclical and banks and energy, all of which are well positioned. The world thinks we're going to have a recession. The market is positioned stocks as if we're going to have a recession. There's obviously a chance we're going to have a recession, but I think that it's going to be a soft landing. It'll be a relatively modest landing.